So how many of y'all were shocked at the move on Friday in the market? It just shot up way beyond anyone's expectations. I was hoping for a pullback on Friday as I sold my call that Thursday, and those shares were taken away, but no one expected this. Hello, my friends, this is Legend. So, on Friday, we had a big pop on SPY, right? You can see, look at this. What a jump up on SPY. For Thursday, we closed at 671.76, and then on Friday, we opened at 676.46. Goodness gracious, right? Goodness. And before we get started, if you don't mind, hit that like button as it does help the channel out and it would be much appreciated. But let's just go ahead and get started. Now, if you remember, on Wednesday, I had sold a put at 668, okay? And then it closed below 668. As you can see on these numbers right up here, that C, that's the close price right here, okay? So if I hover over this candle, you can see that that close price is $667.80. So I was assigned those shares at $668 per share for 100 shares because I sold one contract, right? So I was assigned those shares at $668. So the next day, when it started moving up, I went ahead and I sold a call stating that I am willing to sell my shares at 671, okay? Now I bought them at 668, and then I'm going to sell them at 671. Well, that's a $3 move. That's pretty good money for one day, if you ask me. And what did it close at? It closed at 671.76. Therefore, since it closed above 671, my shares were taken away. So I was pretty happy with that. Right? So I thought, right? Because I was expecting really this to pull back a little bit on Friday. And if it did move up, I didn't expect it to move up too much because this here was pretty much the high, right? Around that 674, that was pretty much the all-time high. Well, after Friday, that's past tense, right? Because Friday, it made a new all-time high. Because even though it closed at 671.76 on Thursday, it opened on Friday at that 676. That's almost a $6 move overnight, right? From the time of that close to the time of Friday's opening, it moved about $6. Huh. If that price had only not made it up to my strike, I would have still owned those shares. And then when it opened at that high, my mouth would have just fell open, right? Because I would still have owned those shares and then I could sell a call at the money, right? I would sell it at the money because we're at all-time highs. And that hopefully would have been taken away at that point. Now, could this thing keep moving up? Sure it can. But who knows what tomorrow is going to bring? In this case, Monday. Who knows what Monday is going to bring, right? It could come down and it could keep moving up. Who knows? But off of a jump like that, I would have took that in a heartbeat, right? I would have sold at the money call, probably just above the opening. Since it opened at 676.46, I would have probably sold it right at 677, possibly 678. Now, if I'd have sold it at 678, since it closed at 677.25, those shares would not have been taken away. But had I selected 677, those shares would have been taken away, right? And at 677 and my purchase at 668, that's a $9 move. So $9 times 100 shares is $900 over a period of 2 days. Wow. That is some really good money. And percentage-wise, what would that have been? And we're just going to go with that 677 because we're just playing the what ifs, right? This didn't happen, but it's just the what ifs and just for fun. That $9 move be $900, right? And we're not even going to count the premium that I would have earned. We're only going to count the price appreciation. So if you were to add the premium on top of this, the percentage would even be better, right? So we're going to take it with just the price appreciation, just for this fun example and experiment, right? So that $9 move times that 100 shares, right, for the one contract, that's going to be $900. And we take that, divide it by how much I had invested. Well, I purchased them at 688. So that's 68800. All right. So 688 times 100 is $68,800. So yes, that is a big chunk of money. But I'll explain why later in this video of why I am not worried about owning shares of SPY, which is off of the S&P 500. But for that percentage, making that $900 and utilizing 68,000, that is a 0.013 times 100, and that takes it to the percent, right? So we're at 1.30%. Now you're thinking 1%, that's not that great, is it? No, that is extremely great, right? Because that would have been over 2 days, all right? So that 1.3% divided by 2, because we're going to take it down to a per day, right? So that per day would have been roughly 0.65% in 1 day. So now let's just get a little crazy, right? Let's take this 0.65% per day, and let's just say, what if we did that per day for a week, right? So we'll just take that times 5, and that gives us 3.27% per week, right? Oh my gosh, this thing is getting crazy, right? It still may not seem like a lot to you, but believe me, over 3% in a week, that is crazy. So now let's just take that and let's get even crazier here. So that we are showing for a week, and if we take that times 52 weeks in a year, so the projected estimated yearly income off of that play is basically a yearly return of 170% for the year. Oh my gosh, is that not crazy? But that was off of using this crazy huge jump. And we're not going to make no $900 every single time off of the price appreciation, right? We're not going to be able to do that. Now, could we make $900 if you add in the option premium and the price appreciation? We might can get close, maybe a good half of that, but I still don't think we would quite get that much. And like I said, that's the reason why this is just playtime, right? We're just really shooting for the moon here. But let's use something that's a little bit more maybe realistic, right? So we'll just use what I actually did make, right? Where I bought at $668 and I sold at $671 for a $3 move. Now that's not too unrealistic, right? Now, can that happen every day? It could, but would it? Probably not. But again, we're just searching for rainbows and sunshine here, right? And just having fun with some numbers. So if we take that $300, all right, and again, that was a $3 move in price appreciation, but I did make $100 in the premium and $85 in the put. So technically, I had $485, which is almost $500 worth in just 1 day, right? But I'm not going to count the premium. We're just going to use that price appreciation, which is $3. All right, so that $3 times 100, that's $300 in price appreciation. And we take that, and if we divide that by the amount that I had put up for this, and again, that was that same $68,800. Now, what is that value? And that is 0.004, we take that times 100 to change that to a percentage. And now we have 0.43%. Now remember, this one is not for 2 days. This is for 1 day, okay? 1 day. Because remember, I was assigned the put here, right here, and I sold it the next day as the call took my shares away. And you can see, now these candles here, that's not extreme, right? You can see those length of candles throughout this whole thing. So it could happen, but I imagine the chances are a little slim. But again, I am not counting the premium. So that premium could offset. So we could say technically we could possibly make $300 a day on average, maybe. But maybe this would be closer to, say, $300 3 times a week, okay? So we'll use 3 times a week. We're not going to use the 5 times a week times the 52 weeks. We'll even take it down to 2 times. $300 twice a week, $600. But let's see, what is the percentage of that, right? So 0.43%, and that is for a single day. And we're going to say that we can do that twice a week. So we'll take that times 2, okay? So we're at 0.87% for the week, right? Now again, I am assuming the same 68,000 roughly invested, and I'm assuming a $300 price appreciation that I've earned. Okay, so a lot of assumptions, I understand, but this is just for fun. So that's what I have per week, 0.87% per week. Now we're going to say we're going to take that times the 52 weeks in a year. So times 52 for 52 weeks in a year. So the estimated annualized percent of return is 45% in a year. And that's only doing it twice a week. That is great. And I know you may think that that's not much, but I don't know where else you're going to get 45% in a year. Now, for those out there who don't quite fully understand percentages, what does 45% actually relate to in dollars? Well, if we just use that $68,800 and we take that times the 45%, so we'll take it times 0.45 because we're going to remove that percentage so we don't have to divide it by the 100 and all that. So I'm just going ahead and removing the percent. So I take that 68,880 times 0.45. That means that off of that little over $68,000 amount, I will make $30,000, almost $31,000. We are close to half of what we had invested. So that 68,880 just made $30,960. So that would mean the total account now, we would take that plus the 68,800, and that now is going to equal $99,760. So that $68,800 just turned into $99,760 in 1 year, right? 1 year. Now think about this. We were only doing 1 contract. What if we were doing this and doing 2 contracts for each one? Well, everything would just been doubled, right? You would have been using a little over $120-some thousand, but you would have gained $60,000 in that account. And then therefore that total would have been closer to about $180,000. So you just turned your 120 into $180,000. You're close to 200 grand right there in 1 year. Now, it is possible, and you could get that twice a week, right? You could, or the market could fall and you could be holding it, right? And that's what some of you are thinking, right? Well, that's all great while the market's going up, right? Because if I'm buying it, I'm going to need for that market to be at least above what I bought, right? So if I buy it up here and the market drops, I have to wait for it to start getting close so I can sell a call above where I bought it. And that's fine, but what if the market's coming down? What if we're looking at a time period like we were back in March and April, right? What happens then if you bought it and you had it up here, right? Say your put was assigned and you're all the way up here at 603, right? And you're waiting for that to turn around so you can sell a call at 605 or something, because you can see that the high was 613 at this time, right? So it wouldn't be too far-fetched to sell a call at 605. But the problem is what happens? It's dropping, and it's dropping, and it's dropping, right? It drops down to about 552 here. Well, crap, you're kind of getting a little worried, aren't you? And then it starts moving up, and you're like, oh, okay, here it comes. And then it hits that MA 200 and falls again. And now you're worried. Did I just buy something that now is just going to plummet down to a deep, deep black hole, right? And it's just falling. And it falls all the way to 481.80. You can see that right there, 481.80. Whew, you own those shares at 605? Well, what do? Do you sell out of this thing because you don't want to ride it all the way down to the ground? Well, that is your choice. You can sell at any point that you choose. But for me, I'm holding. Why do I hold? Because it's the S&P 500. And to me, the S&P 500 is about a sure thing as you can get in a stock market. Now, nothing in the stock market is a sure thing. And that's why I said it's just about as close to a sure thing as you can get, because it's diversified and it's got the top 500 stocks within it. So if those aren't doing good, the market ain't doing good at all. But overall, it does move up. And we'll come back to this chart, but I want to show you what I mean by it does go up. And right here on this 5-year chart, you can see, look at those candles. We dip down, but look, overall, we move up. Right here's where we're looking right now. This is that March, April area. But what did it do? It just keeps moving up. We have our dips, we have our little heels, but overall, it trends up. It could take some time, as we do have bear markets, right? But once it turns around and goes back into a bull market, history shows that the S&P 500 or a SPY will be okay. Now that's just a 5-year chart. What if we take this thing all the way out? And if we go all the way out to max, look at this. I mean, we're looking back here around 1993, all right? And we were moving up and we dropped, right? And then we were moving up and then we dropped. And then we moving on up, right? Plenty of drops here, 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 here. Plenty of them, all right? So it does happen. But for me, when it drops, those are good buy times. That's a good time to buy in to help add to your foundation. And SPY, VOO, VTI, any of those stocks like that, to me, are foundational investments. And that's my opinion. I'm not a financial advisor. But in my opinion, those stocks are forever stocks, right? Buy, hold, forever. And those you can dollar cost average in at whatever price, right? Some people set these things up to buy a certain dollar amount per day or per week or per month or whatever, because if it's just going to continue to move up, you just about can't go wrong whenever you buy it. Because even though at this point right here, as it was moving up, that looks like that's the high, right? That's the all-time high right here. Well, it is until it breaks and makes a new all-time high. And that's the new one. Until it breaks and makes an all-new all-time high, right? So you can see there are always going to be new all-time highs for a stock or ETF that just continues to move up and to the right. And I will only say that about the S&P 500, okay? This one here is just a banger of a ETF. You just about can't go wrong anytime you buy it. So with that said, back to looking at our day chart right here, where we own those at 605 up here, right? We were assigned those shares at 605, and we're waiting for this thing to turn around. And then we hit this crazy event that just takes it down, right? We were all in this ride down. If you had a portfolio and if you had any stocks, they were down, okay? SPY was down, Microsoft down, everything's down, okay? Didn't matter what you were in, chances are it was down. But what did it end up doing? Well, if you look, we broke above it eventually, right? But that's what you're looking for. You want to make sure that eventually it can recover. And the S&P 500, in my opinion, recovers. So over here, and yes, that's a lot of time, right? I mean, because that is, say, from February all the way over here to about June. Okay? Yes, that's a lot of time. And that could be a lot of time that you lost out on making money. But honestly, there wasn't much you can be in to make money unless you were shorting stuff, right? Unless you were shorting the market through here. But for me, I wasn't shorting the market. I was buying shares. I was buying into stuff, right? Because as it was coming down, all I saw was discount, right? My favorite store was now offering a discount for me to buy. Well, I'm going to buy that thing that I love because I can now get it at a discount. Why wouldn't I? Especially on something that I love, whatever that product is. In this case, it could be a share of Microsoft or a share of SPY or a share of VOO. As it's coming down, I'm just buying a share, right? I'm just buying a share. Now, I didn't buy it on every single day, right? Because that's a lot of money, right? And you don't know where the bottom is. But by dollar cost averaging in, I'm just bringing down my average so that whenever it does turn around, my average isn't up here. It's now down here. And these are for those forever hold stocks, right? The shares that you're holding forever. But it did end up taking until about June before you could have started selling calls against that 605, right? It's very possible it would have took you close to that. Now, did you have to wait that long? No, you didn't. That's the thing. I'm doing daily, but once it started moving up over here, you could have sold a call for a strike above your price and done it out for a month or 2 months, right? And picked up a little premium. It doesn't have to be just for the day. It can be for a week. It could be for a month. It can be for a year. It can be for a couple years if you want, right? But whatever it is, if it does get above it, then you are agreeing to sell those shares at that price. And if it's really far out, then you may be just sitting on that. But I don't necessarily like to shoot it out too far. I like to keep it close. Currently, I'm keeping it within a day, 2 days, maybe a week, right? Because this, I'm really just day trading, right? I'm just swing trading this. So I may go out to maybe a week if I had to. But outside of that, I'm just going to hold it because I don't want that price to get away from me. If I go out a month and this thing shoots $20 past my strike, and all you can do sometimes is just sit there and watch it, right? You can't even roll it without rolling it out too far because the further you roll it out, the more of a chance, yes, you could go down, but it could just keep on moving up. So sometimes either you have to buy it back just to close it, or just let it go through, right? That's why I like to keep it under a week. But if we look at that 5-year chart, you can see that those candles do stay above that red line, and that red line is the MA 500. So when people ask me, when you're putting up $68,000, aren't you worried? How do you sleep at night? Well, it's simply because this is not a single stock ETF, right? This is the S&P 500. I do not rank the S&P 500 with, say, MSTY or MONTLY even, right? Those are higher risk ETFs, and I play them accordingly. But the S&P 500, to me, you just about can't go wrong at any point that you buy it. And that is my opinion. And do your own research before you buy into any of these stocks, right? But that's why I don't mind putting up $68,000 to sell a put, and why I'm not worried even if it would drop. Because history shows me that eventually it will get back up. It could take a week, it can take a month, it can take 6 months, and heck, who knows? It could possibly even take a year, right? But history shows it does move back up, and that's why I'm not worried when I'm laying down $68,000 to sell a put, right? That's why I'm not worried. But anyway, I just wanted to point out this candle here that happened on Friday, and just wanted to kind of mention that, I had sold those at 671, and the next day this thing just pops up, right? But again, who would have known this? I honestly believe that I played it the best I could because it was at the top, and I was assuming we were going to get a little pushback, or even if it went up a little bit, it would come back a little bit at some point where I can sell my put again and be back into the play to sell another call. But who in the world would have known this was going to happen, right? Not me, or else I would have not sold that call, right? I would have not done that. But I was very pleased with my position and the money I did make. And you can't worry about the money you leave on the table, because if you do always wonder if it's going to jump up or if it's going to break that high, then you're never going to make a trade, right? You're always going to be waiting, sitting on the sideline and looking for that big fall or that big jump up. And for those people, they may get lucky and hit that big jump or that big fall. But how long have they been out of the market, and how much money did they lose just sitting and waiting? Because honestly, just dollar cost averaging into the market itself, like the S&P 500, and not trying to catch the highs or lows, you just about can't go wrong doing that. So I think I'm going to wrap it up right there. If you enjoy this type of content, please hit that like button. And if you're not already subscribed, hit that subscribe button as well. It would be much appreciated. And as always, I am not a financial advisor. This is not financial advice. Please do your own due diligence before you get into any stock plays. And until next time, legend out.